This is our Forex blog for February 26, 2013, and these are 4 of the 8 individual currencies indexes: the US dollar, the yen, the pound, the euro, the previous day's high and low, the point of control where most traders have positions in the dollar or euro and so forth, hourly moving average in gray. Green is the 15-minute bar moving average, and we have our statistics on the bottom that compare the dollar to every other tool based on how fast it's moving at that time of the day compared to what's normal for that time of the day. And one of the tools I'm working on creating is what I like to call the Perfect Oscillator. A lot of times you can see information on an oscillator that you can't see on normal charts. And one of the reasons I call it the Perfect Oscillator is because it has zero lag, and it's based on the statistics of each currency, and it really lets you see when markets are likely to reverse. For example, here the market came up and made a higher high, closed down. You can clearly see a lower high on the oscillator value than before, and the market reversed. And the same exact thing happened on the bottom. It came down, rallied up, came down again. We have a higher low, and this is a perfect example of divergence, and it just works over and over and over again. You can see the market was trending down, rallied up, came down, failed to even go back up to the high. You can see substantially lower high on the oscillator value, and it just fell off a cliff there. So when you see, these kind of divergences, and I love to do counter trend trading, not only because a lot of times when I'm trading the trend from the London and Europe session has already gone too far for me to safely buy or sell, so I'm looking to a lot of times do counter trend during the US session, and I'd like to not get my head handed to me. If you get into a counter trend trade wrong and aren't quick to bail, you can lose a lot of money doing that. So that's why I'm always trying to enhance the predictability of our tools. And again, when it's at and below the 80 or upper 80 levels, typically you're going to get reversals, or at least the market's going to stall. So these are pretty decent places to get out. If you get during the pullback and it's underneath the 80 level, you can certainly buy, but typically you don't want to be buying at and above the 80 level. Sometimes the market makes a big move, goes sideways. That's okay. You can see as it's going sideways right here, the oscillator's back to the 0 level. Above 0 it's bullish, below 0 it's bearish, and this is a pretty decent trade right here. You can see in the first bar, the second bar, it's actually gone up statistically more than what is normal for that time of the day, and therefore it's likely to run out of steam. And guess what? 5 more minute bar up, and then it reverses, and you can see it falls 20-30 pips. So if you didn't have this tool, you might say, well, I'm going to hang on to this. It's at 31.20 now. I want it to go up to 31.50, or pick some arbitrary number that so many novice newbie traders do. This is telling you that it's not likely to go up that much more. If you put any chart up, let's just go through some of them here. Typically at and above the 80 levels, you can see the market ran out of steam, pulled back, did it again. Notice the low right here. That's the end of the down move. The high, end of the up move, end of the down move. Right here. Notice the market goes sideways for 30 minutes, and then this resets itself. And so when you see a big move down and the market's kind of going sideways and the oscillator resets itself, it's kind of safe to go short again. And guess what? It comes down again, and this is super weak here. It even goes below the -125 reading. This thing's kind of bottomed out here. And a lot of times you'll see a lower low with a higher low value here, and that's typically a good place to look for reversals. Let's just randomly go through and take a look at these values. And the best way of using this is when you have a trend that's clearly down and you get a pullback and it's at the +80 level and the trend's clearly down. This is a very safe, high probability place to sell, and you can get into those trades usually within 5 minutes of the move happening. And that's what I like about it more than anything. Clearly this is a downtrend. It rallies up. This is when it starts to become overbought, and you can at that point look for sells. Or even if you got short right here, maybe you lost 5 or 6 pips, you get short again, you get your loss back, you get short again here, and this one just kind of goes down 20 pips. This one right here, you make 20 pips, and so forth. And again, look at this sideways move right here, where it rallies up, pulls back, goes sideways. You have lower highs, and so when it breaks down right here, very high probability, very predictable place to get out of your trade. And also look here as it's going sideways. The oscillator resets back to 0. It hasn't come back to the extreme. The market's likely to reverse, and usually anytime you're near the lows where it's just going sideways for an hour or two, the oscillator just adds to the probability here. And of course, it went up here and it was overbought. If you got short right here, you probably lost. The second wave up, you can see it has a higher or lower high. This is kind of during the dead time of the day, but if you got into that trade right here, you might have made or lost 5 or 6 pips. You got short again, you got it back. Just randomly picking currencies to give you an idea. Now here, clearly it's in an uptrend. You get a pullback. It's at the -80. Pretty safe place to get in. And especially for people that like to scalp like myself, I certainly love getting 30 to 50 pip moves, but I have no problem, catching 3 or 4 or 5 to 8 pip moves because it adds up. As long as you're making 15 to 25 pips a day, who cares if it's in one trade or a series of 3 or 4? This one went up, a lot of momentum, pulled back. You might even, when you see a higher high and indicator value being hit, when this gets hit as well, it pulls back. As soon as it goes back above 0, you're in the trade. When it gets above the +80 level, you're just kind of really tightening your stop and maybe moving it up underneath each bar's low, and you're out at 0290. This worked so well on the individual currencies I've been trading it with, and that's one of the reasons I didn't do a blog video yesterday. I was too busy trading and working on this. I'm not going to do blog videos every day. When something new and significant comes out, I'll explain it in the blog so people can learn about it. I haven't released this tool yet, but it will be released probably later this week. But one of the nice things about this is it works so well, and I like the oscillator value so well that I decided to put it into our FX trend intensity tool. So if you go to FX trend intensity, when we release this, again, you don't have this in yours yet. There's going to be a new option called oscillator. And instead of drawing it as a histogram, it's going to give the FX trend intensity, which is very similar formula with the 80 to -80, and allow you to see the actual index. So here you can see the Euro index, rallied up, pulled back. It's underneath its hourly moving average. So clearly the trend is down and you're looking to sell it. But once it starts coming down and you see it's at this -80 level here, well, guess what? It's probably done going down, or at least you want to be cautious about getting out of your trade. And for those who are looking to do counter trend trades, before you wouldn't necessarily rush in to buy it down here, but now knowing the accuracy of this, notice the high here, done going up, right here, hits the +80, pretty much done going up, especially when the trend's down. You might want to get out of that trade. And a lot of times you're going to get many different parts of the trade. A lot of times it's going to go up and hit the fib targets. You can see it hit the 1.27, I think is what this one is. It's at our upper containment band. When you get an overbought condition, very likely to reverse. And you just simply want to trade the euro against whatever's strongest and weakest at the moment. Right here at 5 o'clock, the euro is very likely to go down. So which one's stronger between the dollar and the yen at 5 o'clock? Clearly, it's the dollar. So 5 o'clock, it makes a lot of sense to be looking for euro-dollar sells. So here's the actual chart at 5 o'clock, and you can see that this one's clearly at the overbought stage as well. And it probably makes even more sense to put this on a 5R chart. So which is a 5 pips per bar range chart. And when you see this, there's the 5 at the clock time, and you got a little bit of consolidation here. You can simply, let's get rid of all the lines on here. You can simply go short and put your stop 1 pip above the 5-hour chart's high, and you're literally risking 5, 6, 7 pips here. And once it goes your way, you want to move your, typically I put my stop in half. Now I'm only losing 3 or 4 pips, and I'm just kind of gradually walking it down. You can see it's kind of losing a little momentum here. You might use this as a exit method too. As long as this it keeps making lower lows and lower highs, you stick with it. Here's the first instance where it makes a higher high than before, so you're really looking to get out of that trend, maybe somewhere down here. That's kind of how I've been using it to kind of maximize profits. You can see 31.10 out at 85 for a 15 pip move. If you're regularly just trading this, you might have got out of this trade. In the past, I might have got out of this trade right here at 96, and only actually no, it's a 14 pip move. But using the new method, it's a 24 pip move. And of course, you get a little pullback right here, and the market's kind of, a lot of times these up down patterns are amazing reversals. You go short, and you can see this indicator just keeps going lower. You might want to get out of this trade right here when it fails to make a lower low, and you're out for a quick little 7-8 pip scalp. So many ways of using it, and that's why I'm a big fan of it. But let's scroll these charts back and look at how you would trade this before. The euro-dollar index is weak. It's underneath its hour right here. Last night it went below its 15-minute moving average. Unfortunately, the dollar is also weak at that time. You can see the yen was extremely strong at that time. So you want to, last night, sell the euro yen coming up to midnight. Let's scroll back and look at this. And you can see this one was trending up, and you have a nice little kind of trend line underneath here, and it broke it. Whether you got short right there or you waited for further confirmation when it broke out right here, you can see a very substantial move. It fell from 79 all the way to 80. It's a 100 pip move. And very clearly the chart showed that. The yen last night broke out explosively. Let's zoom this out so we can see the whole chart here. The scaling's designed to work live, and for today only. It doesn't, sometimes has issues when you scroll back. You can see pretty much at 22.40 the yen got really strong, and it was pretty much at the same time, 22.45, that the euro lost its strength. So that was about right here. You got into that trade real early on in the move, and it would have been very easy to make at least 50 pips even if you held for 15 minutes. And that's how you use these indexes. And you can draw trend lines on them. You can, for example, with the euro here, you have a nice little trend line there. You can duplicate a trend line, draw it over the bar's high to show a likelihood of a reversal. You can see later or earlier this morning, around 8, it's in this trend line, trend channel, and it couldn't even come up to the highs. Very likely at 8 to be reversing. And if you look at the dollar index chart, the dollar was kind of inching its way forward, and at 8 o'clock it was going back above the point of control, which is the price most traders have dollar pairs long or short from the previous day. And what an amazing trade. You want to sell the euro dollar around 8. And so as you scroll and look at this, if you look at this chart here, it's just kind of going sideways, but the individual dollar and individual euro index chart was clearly showing around 8 that this pair is about to fall. And it took it about 10 minutes, and it fell from 30.84 maybe down to 52. Nice little 30 pip move in 20 minutes. And that's why we use the index. And combined with the new Perfect Oscillator that I came up with, it should really not only help you do trend trades, but also dramatically improve your odds of catching successful counter trend trades.